Stocks in the U.S. seeing red today as investors digest a batch of big tech earnings and another rate cut by the Federal Reserve. Let's bring in Michael Green, Chief Investment Strategist at Simplify Asset Management. Thanks for joining us today.
Oh, it's a pleasure to be here. Thank you for having me.
Let's start, if you don't mind, with the discussion between Washington and Beijing, the leaders. Coming to some basic terms, what is your overall take on how that went?
Well, my take is that it generally has gone as well as could be expected, but both parties in this situation are looking for time. And so de-escalating for a period of time without fully reversing the process of conflict is really what I think we should expect going forward. China and the United States have very different visions of the world moving forward. They both are ultimately looking to prosecute their own agendas. And they both see time as being on their side. The United States would really benefit from the ability to diversify away from our dependence on things like rare earths and other supplies. China is looking for the capacity to build their military and continue to make gains in areas like semiconductor chips. It makes perfect sense that we're all willing to step away from the table for a little bit under at least semi-favorable terms.
Okay, so you see this more as both sides perhaps buying some time to do what they need to do. Do you think there will be a clearer understanding or something more formative later?
My hunch is that we will continue the process of de-integrating China from the United States, and that we would expect to ultimately see this play out in repeated cycles over time. Very similar to how we've seen trade negotiations when they have emerged between conflicted nations in the past. It would be unrealistic to expect that we would immediately go back to a giant kumbaya where we all love each other.
Is there a clear understanding, do you think, of how tariffs are working through the economy in the U.S. with no official data coming out for the last month because of the shutdown?
Well, I think it's really critical to understand the role that tariffs play. Tariffs are simply a tax that is designed to drive consumption back towards a domestic producer, recognizing that ultimately, particularly when you have retirement systems like we have in the United States that are predicated on money being spent by those who are entering retirement, we're simply trying to provide a little bit of a bias to push those purchases domestically and provide increased income for the American workers on which those retirement systems rely. You're not going to really hear a lot of people talk about it that way, but that is really what we are trying to do. The national security components of it are obviously significant, but at the end of the day, we need to have people buying products internally if we're going to provide those retirement services. Otherwise, we're deeply disadvantaging the younger generation. That's really what I think the tariffs are about, is driving a rebalancing of our society. It's going to take time to get there, and we need to find out first whether the Supreme Court is going to support those, whether Congress will ultimately support them, and whether this turns, as we saw in 2018, into a longer-term phenomenon in which successive administrations maintain the tariffs.
Let's talk about labor as well in the U.S. What shape do you think it's in?
Well, I think the labor markets are weak in the United States. I think it's a combination of factors that are driving that. One is just very low overall labor force growth that's tied to demographics, the aging out of the baby boomers, as well as the significant reduction in terms of immigration that is occurring in the United States. But even within that low labor force environment, we've seen a dramatic decrease in hiring activity as uncertainty about the state of the economy, the state of political play, and equally important, the state of things like the development of AI or LLM are impacting the ability for younger generations, younger workers to obtain first employment. That's really where we see the stress. And it makes perfect sense. Things like AI or LLMs leverage experienced workers. They really provide no additional benefit to the new worker who is in many ways viewed as being replaced with the introduction of AI.
Let's talk about NVIDIA as well when we talk about artificial intelligence hitting the $5 trillion mark this week in valuation. You say you see a price weight spiral happening. Can you explain that?
Of course. So when you invest on the basis of index investing, particularly market cap weighted indices, there are two components that are really important to understand. The incremental investment that is happening when you save towards your retirement is being allocated on the basis of market capitalization. The problem is that liquidity does not scale with market capitalization. NVIDIA is more than 100 times larger than the smallest stock in the S&P 500. It's probably in the order of 10 times more liquid. As a result, that larger order, because it's market cap weighted, is driving the price of NVIDIA higher, increasing the concentration, and that increased concentration translates to even more of the next dollar into the market through a passive index, buying even more of NVIDIA relative to those smaller stocks. That creates a price-weight spiral, which is ultimately what I think what we're seeing right now.
Okay. I also wanted to get you on the Fed Reserve cut of 25 basis points this week. Is this enough to see a stimulus in the market? I'm wondering if there's a benefit from that you can see.
No, I think it was fully priced in. There will obviously be very marginal benefit from those who benefit from a very slight reduction. We may see some improvement in terms of mortgage financing, although the reality is that's further out the duration curve. And because Powell called into question whether we are going to have a cut in December, we've actually seen 2 years and 5 years sell off a little bit. That's now carried across the rest of the curve. Importantly, when you think about some of the things we were highlighting before, when bonds fall, ultimately a portfolio that is rebalanced between bonds and equities now suddenly needs to sell equities and buy bonds. I think that's part of the weakness that we're seeing in the aftermath of the Fed meeting today is disappointment in the bond sector that there was not a stronger endorsement of further cuts. My hunch is that this is a temporary phenomenon.
All right, Michael Green, I got to leave it there with you, sir. Thank you for your time. Michael's the chief investment strategist, Simplify Asset Management.